In today's video, I want to see if I can explain what's going on with the metals and especially the miners. So, during the bear market, I was one of several people that recognized that the metals sector was being manipulated and being manipulated into a bear market. Of course, I suffered all kinds of ridicule. Many people, said that I was wrong. These were natural markets. And of course, come to find out later, I was exactly right. The banks admitted to manipulating the market and are paying fines. Um, that being the case, I think, well, I'm about as sure on this one as I was that the metals market was being manipulated, that the manipulation has now moved into the mining sector. The banks got busted manipulating the futures market in gold and silver. So I don't think, and I haven't really seen much evidence of that lately. And I don't think they can continue that. They've gotten busted once and have paid multi-million-dollar fines. They get busted again for doing the same thing. You got to think that somebody's going to spend time in jail. So I think manipulation of the futures market in the metals is probably done. But I don't think the manipulation of the metals sector is done. I think the manipulation has just moved over to the mining sector. The banks can short, the gold mining stocks or the gold ETFs. They can short those as heavily as they want. There's nothing illegal about that. It was, in theory anyway, illegal to exceed position limits in the futures market. And now that they've gotten busted, I just don't think that's going to happen anymore. But I do believe they're going to try to manipulate the mining sector. So let me switch this over to a longer term chart, and I'm going to see if I can explain why this is happening. So first off, the metal sector it satisfies a couple of requirements. It's big enough that the banks can put some real money to work in it, but it's small enough that it's fairly easily manipulated. So clearly the reason to manipulate the market down is that the lower the banks can force the market, then the bigger the rally will be once they release the market to move back to the upside. We saw that in spades in 2016. So we had this manufactured bear market. We had the breakdown in 2013, and then you can see this was a very difficult bear market to continue to manipulate lower, because it really wasn't supposed to go lower. We had global QE. Some of that money should have sloshed over into the metal sector. Just wasn't allowed to do that because the banks were manipulating the futures market, and of course the miners followed it down. But you can see this was a very difficult move. Every little breakdown, there was no follow through on it, and you get a move back up. So all the way down until we get this final washout here, where the banks manufacture this undercut low, and then they release the market, and what happens is exactly what I said was going to happen, that once the manipulation ended, there would be a very big, very huge, large rally as the beach ball, so to speak, shot back up to the surface, and then it explodes back into the air. So we get this almost 200% rally off of this bear market bottom once the manipulation ended. Now, however, instead of this baby bull just leading to another big leg up, I think there are two things at work here. For one, we're going into the bubble phase in the stock market, so there's easy money to be had in stocks. So there isn't a lot of motivation for people to fight with this metals market. I think there would have been if we could have had our natural bottom here in October and then started back up. Then I think there would have been a lot of buying interest. But we got that big reversal in the stock market on election night, and that bled over into a big reversal in gold, which knocked it back down below its 200-day moving average. and I think it just knocked the entire sector into probably at least a year, maybe a year and a half, 2 year long basing pattern. And so that just opened the door for the banks to start running their scam again. And I think that's exactly what's in process. That they're going to. I've been saying for weeks now. Let me switch this back over to a shorter term chart. So I've been saying for weeks that the fact that the mining stocks didn't follow gold to new highs above this February high was a warning sign that something fishy was going on. And I said weeks ago, I said I think the banks they're gonna make an attempt to run those December lows in the mining stocks. And you can view this in one of two ways. If you listen to me and you got out of your stocks and you're sitting on the sidelines or you're short, then you're okay. You've locked up your profits and you're ready to follow behind the banks, because what they're going to try and do is create another huge buying opportunity, exactly the same as they did back here in January of 2016, a second baby bull, so to speak. So you can be stubborn and you can stand in front of them and the train's going to run over you, or you can follow along behind them and the banks are going to create an amazing buying opportunity for metal investors. Probably not till, I would guess, probably not till June. We're not even done with this daily cycle yet, and I suspect this daily cycle before it's over is going to break the March low. So we're going to have a failed daily cycle here, more than likely, and that makes sense. If the banks have started shorting heavily here, then they're going to want to run these lows, and then they're going to want to cover their shorts into the technical breakdown below the March low. So we're probably going to get a bounce tomorrow. We're getting very oversold, so we'll probably get a bounce for a couple of days. But then I think that the banks are going to make sure that we run these March lows, and they're going to want to cover their shorts into that technical breakdown, and then we'll have another bounce, and then we'll probably have our bloodbath phase into June. And I'm willing to bet that the banks are going to accomplish their goal. They're going to break below this December low, and they're going to manufacture an incredible buying opportunity again, just like they did back here in 2016. Now, I don't know if they're going to be able to drive the mining sector all the way down to the 2016 lows, but I'd say there's very good odds they're going to push it below the December low. They're going to run those stops below that. So this is what happens at every one of these major tops and bottoms. When I was trying to get people to buy here, 90% of traders would not listen to me. Subscribers are canceling their subscriptions. And, they think I'm an idiot, that I don't know what I'm talking about, and so they miss the rally. And we got out right up here at the top. I did not bother trying to catch this move here. When this correction went that deeply, I already knew something was up. I knew it at that point that the mining sector was under attack again, and I just didn't want anything to do with this rally. It was just too dangerous, in my opinion. And so I put in a trade to get short right here when the GDX tagged its 200-day moving average, and we were very late in this daily cycle. And as most of you remember, I called that we were going to get a top either of Thursday of last week or very early of the next week, which we ended up actually topping on Monday of that week. So that call proved to be correct, and we're now working our way down into the daily cycle low, and you can keep holding and hoping that this is going to turn around, but it's just not. The banks are in control of the sector. They're going to break these March lows. They're not going to cover their shorts until they do. That's going to cause, it's going to trigger a lot of stops. A lot of people will be selling short or just selling their long position. So there'll be a lot of liquidity to cover those shorts into. They'll cover into that weakness. And then we'll get a bounce, and then I think we'll have that next bloodbath phase into June. So the same thing, well, actually the exact opposite happens up here and here as what happened here. At the bottom here, I'm pleading with people to get long. They won't do it. They're canceling the subscriptions, and so they miss the rally. At the tops here and here, I'm pleading with people to sell their positions, take their profits. They won't do it. They canceling their subscriptions. They're looking for somebody that's going to tell them that their miners are going to the moon, and so then they end up getting caught in this. So it's just that's the way the world works. 90% of the people have to be wrong, and only 10% of the people, generally make money. So at the bottoms, when I'm calling for people to buy, nobody wants to buy. The tops, when I'm pleading with people to sell, take the profits, nobody wants to sell. So I'm going to suggest you on any up day, any chance you get to escape, get rid of those long positions, and then get on the sidelines and wait for the December lows to break, and it's probably not going to occur until June. And the banks are going to manufacture for you one hell of a buying opportunity, just like they did right here in January of 2016. Be smart enough to follow behind them and wait for that opportunity to materialize before you play this sector again, because the rally out of that bottom is probably going to produce the best gains of the year. But if you stubbornly hold your positions, then you can't take advantage of it. All you can do is hang on for a huge ride down and huge losses that may take a while to recover. It's better to get on the sidelines and take advantage of the opportunity the banks are going to create for you.